Welcome to The Economist in Your Ear podcast. Today we're asking a fascinating question. Can a stock market truly defy gravity, soaring to new heights even when the underlying economy appears to be, well, struggling? We're talking about China, where the Shanghai Composite recently hit a 10-year high, up an astounding 36% since the start of the year, even outperforming global indices like America's S&P 500. Yet reports suggest the economy is navigating some significant headwinds, from overcapacity to intense domestic competition, and official data has been more sluggish than expected. Many call it a disconnect from reality, but we're going to challenge that notion today. We'll pull back the curtain on this puzzle, digging into the hidden forces driving it, and crucially, what it means for your understanding of global markets. So let's try and set the stage for this intriguing riddle. On one hand, you have the Shanghai Composite Index performing exceptionally well, right? A real beacon of investor optimism. This rise has, for Chinese investors, often meant that the grass isn't greener elsewhere, which is a notable shift from past trends. But on the other hand, the Chinese economy seems to be grappling with some serious challenges. We've seen significant overcapacity leading to really intense competition in key sectors.
Right, particularly in areas like electric vehicles and solar power.
Exactly. Even giants like BYD, China's most successful EV firm, are feeling the pressure, and some large solar companies reported growing losses in the first half of the year. And this isn't just about big industry. Even delivery platforms are apparently caught in fierce price wars. And then, recently released macroeconomic data confirmed a broader slowdown, with key indicators like consumer spending, industrial production, fixed asset investment, all growing slower than anticipated. It paints a picture of underlying economic struggles, doesn't it?
It absolutely does. And what's often highlighted, even in some analyses we've seen, is this seeming disconnect from reality, especially when you look at corporate earnings. More than 22% of mainland listed companies reported losses in the first half of the year. That's the highest rate in at least 4 years. That undeniably points to challenges at the company level, no question. But to suggest it's just disconnected or merely pure euphoria, well, I think that would be to miss a much deeper, more calculated story unfolding. This isn't simply an emotional market spike, It reflects a multifaceted shift in policy and how capital flows and in market positioning that's truly crucial for us and for you to understand. It feels more like an engineered rally, not just a spontaneous one.
Engineered, that's quite a strong word. You've highlighted these significant company losses, so if it's not simply a disconnect from reality or pure euphoria, what stronger evidence points to this more calculated, deeper story? What makes this different from past bubbles, which often were driven by emotion, right?
Yeah, that's the key question. I think it comes down to deliberate policy actions and a strategic rerouting of just colossal amounts of capital. The first big insight is Beijing's strategic deployment of what some are calling patient capital. Since January, regulators have been repeatedly nudging insurers to significantly increase their equity exposure. We're talking guidance to deploy hundreds of billions of yuan.
Hundreds of billions.
Yes, followed by an additional quota announcement in May. Now, this isn't speculative hot money from retail investors, the kind that drove the spikes back in 2015. This is patient capital by design. It fundamentally changes the market's character because it provides a base of long-horizon, stable buyers. They're buying for the long term, not, for a quick flip.
Okay, so the state isn't just allowing investment, they're actively directing it through these large institutional players. That makes sense. But even with this patient capital, if the underlying businesses are struggling, how does that translate into a sustained rally? Where does the confidence come from?
Well, that brings us to the second dynamic, a concerted effort against what's known as involution.
Involution.
It refers to that intense, often destructive price competition that just erodes profit margins. Think of those EV and solar industries you mentioned earlier.
Right, locked in that race to the bottom.
Exactly. July's Politburo meetings and subsequent moves unveiled a new legal and administrative toolkit designed specifically to curb these disorderly price wars. This includes things like a draft pricing law amendment and direct warnings against herd investment. Now, if these measures are enforced effectively, and that's a key if, they have the potential to significantly support margins in sectors that previously competed purely on price. And the market right now isn't necessarily waiting for these future profits to materialize on paper. It's pricing in the option value of that future profit repair. It's a forward-looking bet.
A bet on Beijing's ability to shape market fundamentals.
Precisely. It's a bet on policy working.
This is fascinating. So Beijing is not only pushing money into the market via institutions, but simultaneously disciplining how companies compete, aiming to sort of fix their margins directly. It really sounds like they're trying to engineer future profits. Am I grasping that correctly? That this is a direct bet on their ability to shape market fundamentals, not just react to them. And, well, how do we distinguish this from just political rhetoric? What signals should we or you listening look for to know these anti-price war measures are actually effective this time around?
You've absolutely hit on the crucial point there. It is a direct intervention designed to fundamentally alter market dynamics. And this dual approach, injecting buy-side depth, the patient capital, and enforcing supply-side discipline, it creates an environment where multiples can expand ahead of actual earnings improvements. It's the expectation of profit repair, driven by these tangible policy interventions, that seems to be moving the needle. As for distinguishing rhetoric from reality, well, we need to look for concrete enforcement actions. We can talk about that more when we look at future signals, but the intent behind the policy is undeniably there.
Okay, all right. So we've established Beijing's active hand in this, but what about the more, let's say, organic forces at play? How are those colossal pools of private capital within China reacting to this environment? Where is that money going, and how does it impact the market?
Yeah, that's the other huge piece of the puzzle. We're seeing capital being reallocated on a massive scale.
Yeah.
Households in China sit on roughly, get this, 160 trillion of deposits. That's enormous.
Wow, 160 trillion.
Exactly. And with deposit yields currently quite low and the property market still looking, well, constrained, we're beginning to see early trickles of this huge sum finding its way into equities. Now, crucially, retail investors still aren't the primary driver of this market surge, which suggests there's significant runway left for this shift to continue. As more household savings potentially pivot toward the stock market. And because it isn't a retail-led frenzy, that adds to its potential stability, unlike 2015. And then there's property easing. It's been incremental, sure, but it's providing a subtle yet important tailwind. Recent relaxations in property restrictions, like Shanghai's moves back in August, broadening eligibility, they aren't really about creating a new property boom. That's not the goal. They're more about stabilizing household balance sheets and collateral values. This just provides a more secure foundation for overall equity risk-taking. People feel a bit more confident about their broader financial health, maybe freeing up capital to flow elsewhere.
So it supports confidence, indirectly.
Exactly, indirectly. And we also can't overlook the narrative bid coming from specific sectors. Domestically, you have breakthroughs in artificial intelligence, like model upgrades from DeepSeek and a broader AI push. These have become policy-friendly bright spots. This helps to keep that growth leadership narrative onshore, even with all the global noise about chip exports. And externally, exports have actually surprised to the upside recently, showing more resilience than maybe expected. This resilience helps temper some of the worst-case macroeconomic narratives that were circulating, and it provides support for cyclical stocks, kind of cushioning overall growth. So you put all these factors together, and it points towards the rally being largely institutional-led. Unlike 2015, things like margin financing and ETF retail inflows remain pretty contained. This makes the price action feel steadier, more durable, even if the earnings, the sheer number of companies actually turning a profit remains quite narrow right now.
That's a really crucial distinction from past market behavior, the institutional versus retail aspect. Now, we've touched on how some analyses might see this rally as disconnected from reality, especially given those weak earnings reports we mentioned. But based on everything we've discussed, these policy interventions, the shifting capital, is that really a fair assessment? Or are we missing a key piece of the puzzle about how markets in China are functioning right now? Does that narrative perhaps oversimplify things?
I think it does oversimplify it, yes. While it's absolutely fair and important to acknowledge the near-term profit struggles, the highest rate of loss-making reporters in years is significant. It's critical to remember that equity markets typically price future expectations, not just the present snapshot. The market isn't simply ignoring current profit and loss statements. I think it's more accurate to say it's pricing in the policy-induced mean reversion in margins.
Mean reversion, meaning profits eventually getting back to normal levels.
Exactly. The kind of reversion that the new anti-price war framework and those consolidation signals are designed to achieve, this is precisely about profit repair in the longer term. Driven by deliberate state intervention to improve the quality of earnings, not just their quantity. It's fundamentally a bet on policy efficacy. And furthermore, to call these drivers merely sentiment props, well, that doesn't quite capture their weight, I feel. The rally isn't just about, cheerleading films or new AI model launches. It seems anchored in concrete, ongoing factors.
Right.
Structural buyers, like those insurers and state-owned enterprise, or SOE funds, they provide a durable bid. And then there are the targeted reforms, the pricing law, fair competition enforcement. These are tangible operational changes, not just ephemeral sentiment boosts that could vanish overnight.
Yeah.
They represent potentially fundamental shifts in how the market is structured and regulated. And one more point on exports. The narrative that shipments have simply collapsed due to tariffs also needs a bit more nuance. Our sources indicate that shipments have actually rotated by market rather than undergoing a full collapse. This rotation is actually consistent with the index's cyclical resilience, even under trade uncertainty. It doesn't necessarily signal a full disconnect from global economic realities.
Okay, so it's a much more complex picture. With all these factors at play, the policy-driven liquidity, the anti-involution efforts, shifting capital, and this more nuanced view of market health, what are the key signals? What could either validate this rally, confirming its underlying strength, or conversely suggest it's actually quite fragile and about to, reconnect with fundamentals more abruptly? What should you, our listener, be watching for to really understand the future trajectory of this market?
Right, that's the key question looking forward. We need to observe the concrete follow-through of these policy signals. That's paramount. So for bullish confirmations, you'd want to look for tangible evidence of enforcement under that new pricing law amendment. Actual fines or settlements against companies engaging in disorderly competition that would signal the margin repair story is becoming real, not just aspirational.
Real teeth behind the policy.
Exactly.
Yeah.
Continued insurer allocation or any public disclosures from SOE or sovereign national team funds stepping in, that would confirm a durable institutional bid remains in place. And if exports manage to stay positive through, say, the fourth quarter, that would provide a crucial cushion for overall economic growth, really bolstering the market's foundation. Conversely, there are definitely clear risk flags to keep an eye on. Another weak activity print, perhaps retail sales or fixed asset investment, continuing to underperform without fresh, decisive policy follow-through, that would be a significant concern. The market needs to see action, not just words.
So weak data plus policy inaction equals a red flag.
Precisely. Also, a cooling in buyback and insider purchase momentum, remember? There was a pushback in April that would also be a flag, possibly indicating internal confidence might be waning. And critically, probably the biggest warning sign would be a sharp pickup in retail leverage. A return to the kind of speculative, debt-fueled behavior we saw in 2015, that would quickly erode the rally's quality and signal its foundations are becoming much less stable.
So ultimately, what we seem to be seeing is that the market isn't just levitating in a vacuum. It's actively discounting these policy moves and capital flow dynamics, which often show up before tangible earnings improvements do. If Beijing's campaign against disorderly competition really translates into concrete enforcement, and if that long-horizon capital keeps rotating from deposits and property into equities, well, then this apparent disconnect could very well narrow from the profit side catching up rather than the prices side crashing down. Which leads to a final thought. What if the disconnect isn't a bug, but actually a feature of an economy undergoing a state-managed recalibration? And what implications does that have for global investors? Thanks for listening. Follow us to stay updated with the latest insights on The Economist every day. And don't forget to like, comment, and share.